and welcome. I'm Chris Rowe. I'm the founder and chief investment officer at Avalon, and I greatly appreciate you joining me here today. I know your time is very valuable, so I'm just going to cut right to the chase, be pretty blunt, and not sugarcoat anything. There's a lot of bad financial advisors out there. And I know this because I've spent years, decades actually, in the finance industry, and I've seen plenty of them. As a matter of fact, my career began on Wall Street as a professional investor, portfolio manager, and just managing investment portfolios. Then about a decade ago, I founded Avalon, full-service registered investment advisory firm. I'm talking with some of my advisor buddies from my Wall Street days, and I can tell you two things about their attitude toward the market right now. They are super stressed, and they are completely checked out. It's a little phenomenon I like to call advisor funk. They put on their game face to talk to their clients, but when they get off the call, they're back to playing their Xbox in their boxers with very little regard for what's going on in the markets. So if your advisor or your quarterly return has been nothing but a disappointment lately, I can explain why. You might not want to hear this, but your advisor might deserve a big fat F. They are failing at their job. Most advisors are in over their heads right now, and market volatility is causing huge losses to everybody's accounts if the advisor isn't adaptable. Now, doing the right thing for investors is usually more challenging for the advisor, as the right thing is often not the comfortable thing, and often not what everyone seems to be doing. In fact, you should be the minority if you're an investor that's successful. It's why the vast majority of advisors don't do what's right, but instead they do what's easy at the time. They want the easier conversations to have, or they take the even lower road by following what everybody else is doing and putting zero thought, zero effort into your portfolio and the volatility that it has. And it's a shame. So today, I'm going to pull back the curtains on the entire industry, and then I'm going to give you a quick test that you can give your advisor. If they can't answer these 5 simple questions, I'm sorry, but they deserve an F. They're failing, and they're doing a serious disservice to you and your portfolio. But please don't blame yourself. It's not your fault. If you're here, that means that you are actually taking an active approach to your investments. And that's something that you should pat yourself on the back for, because I'm going to help you take the next step to make sure your investments are on the right track, starting right now. So let's dive in. Like I mentioned before, there's a ton of bad advisors out there, so it's important to have a good one on your side. They're rare. They'll be there to help you achieve your financial goals. They'll be there to help you manage your investments and avoid costly mistakes. Most importantly, finding a good advisor can be very challenging, but it's worth the effort. Consider that the average nest egg among Fidelity accounts lost 23% in 2022. And that kind of hit can be devastating to your portfolio when you watch the portfolio value decline. But a trustworthy advisor will work with you to develop an investment strategy that is right for you, that's right for your goals, and most importantly, your tolerance for risk, your tolerance for volatility. Plus, the best financial advisors spend years honing their investment strategies. The right advisor is always worth the cost. So how do you know if your advisor is a good one? You need to find out if your advisor knows these 5 key details about your account. It's kind of like a doctor. They need information on you to do a good job. And if they haven't done the work to collect all this information, they are not in a position to help you to the best of their ability, meaning they don't have the skills necessary to manage your accounts, or even worse, that they're a predatory advisor not acting in your best interests. I know that sounds harsh, but I'm telling you, I know a lot of advisors on Wall Street. And before we dig in, don't worry about taking notes or anything like that. I'm going to make sure that you get the full report, how to find the best financial advisor for you, along with the bonus Grade Your Advisor checklist right in your inbox. That way you can just give this your full attention right now, digest it right now, and refer back to your checklist later. Maybe even on your next call with your advisor. Okay, first up, detail number 1, your advisor should know, updated in real time, how your entire investment portfolio is allocated, all of it, whether it's under their management or not. That means even if you have a couple of accounts at JP Morgan, another account at TD Ameritrade, another one over at E-Trade, maybe a pension fund, another one over at Avalon, your advisor should know how those combined accounts are weighted in terms of asset categories or asset classes and sectors within those asset categories. So for example, let's say you have 64% of your account in US stocks, US equities, across all 4 accounts. Your advisor should be able to tell you that 30% is in tech stocks, 25% is in industrial stocks, 23% healthcare, 22% energy, so forth. They should also know, each individual investment advisor should also know what percentage of your portfolio is in cash at any given moment. For the best advisors, this is a no-brainer. Imagine having a doctor that didn't know everything about your medical condition or what medicine you're already taking. So advisors should have software capable of compiling all of your account information from all the various accounts out there once you've given them permission. So they can use data feeds to plug into one centralized location. They should be able to access it quickly and easily and display it to you in the same way. If this simplest of questions can't be answered, it's time for you to find someone new. If they don't know where all of your stuff is and what the weightings is, if they can't look at it the same screen as you and go over it, get out fast. All right, now let's talk about detail number 2. Your advisor should be able to stress test the total invested asset portfolio under various market conditions. And they do this to determine what the portfolio would likely do in such a market condition or something similar to it. So what do I mean by that? Well, your advisor should be able to tell you how the value of your portfolio would change in a climate like the year 2008, or from the 2007 top down to the 2009 bottom, or like 2020 when COVID hit, or if interest rates are going to pop by a couple percentage points. They should be able to tell you how the value of your portfolio would change in that case if interest rates were to, let's say, go up by 2 percentage points. For a competent and a well-equipped advisor, this is simply a matter of plugging your information into various software tools. It can be done in a matter of minutes. If this seems like a difficult task for them, you should be worried. All right, on to detail number 3. Your investment advisor should have determined long ago at what point your emotional boiling point would be reached. You want to figure this out well ahead of time. While this might sound impossible, it's actually not that difficult to do. Good advisor has, again, software that can assign you a potential risk score that speaks to the level of volatility that you can withstand without it distracting you from dinner. All right, everyone's different, and not everybody is honest with themselves about what they can really handle. So this is actually something that you should determine and review every so often. And a good advisor will use real dollar values, like the exact dollar value of your portfolio and the exact dollar value that your portfolio could decline to when they ask you a series of questions about how much volatility you can handle comfortably. So with these answers to these questions, they can determine your personal risk score or your stated risk score. So it's the risk score based on the answers that you gave to the questions that they asked. And they should be able to also assign a risk score to your entire portfolio and each account that makes up the entire portfolio. So it should be updated when the advisor has regular discussions with you. Now, detail number 4 will go hand in hand with number 3. So listen carefully. Your advisor should also determine your portfolio's risk score and make sure it's close to your personal risk score. So for example, your personal risk score is a 67, but your portfolio's risk score is an 84. Then you need to get out of that situation immediately. You need to change your portfolio's weighting to get your score down near a 67. So you want your portfolio's risk score to match or be very close to your stated personal risk score. It doesn't have to match exactly, but it should be close. When the market climate inevitably changes, and it can change pretty fast as we've seen lately, a portfolio with much higher risk scores than your personal risk score, your stated risk score, will cause the dollar value of your portfolio to decline faster and past your boiling point. And that's the key. You want to stay away from that boiling point. This is going to cause you to panic, potentially make mistakes with their investments. Nobody gets out of their portfolio and makes changes to their volatility levels when things are going great. They only do it when things are going poorly, which means that your portfolio has declined, and that is not a good time for you to be hopping out of your investment approach. A lot of advisors out there are going to be afraid to have this conversation with you because they're afraid of what it might lead to. It's a difficult conversation sometimes, and they want to retain your business, and that's first and foremost in front of their mind. Investors too often want to be romanced instead of being told the truth about realistic expectations. It's the biggest killer for individual investors. Most come into a relationship with unrealistic expectations and want high returns with low risk. I'm telling you from experience, a lot of investors, they want you to tell them what they want to hear. A good advisor not only knows how to achieve a high risk-adjusted return for the investor, but also has a strong relationship with the client and is confident enough to tell it like it is. If your advisor is lying to you, romancing you, even if they're telling you what you want to hear, then that advisor is a predator. Finally, that brings us to detail number 5. A solid investment advisor needs to know what your criteria are in order to have good judgment about whether you should even take on the risk that you say you're willing to take. So you might say you're willing to take a certain amount of risk, and they need to be a good judge of that. If you want to be conservative in order to feel comfortable investing, then that's okay. I want to say that again because it's so important. If you want to be conservative in order to feel comfortable investing, that's okay. You can still beat the benchmarks while being conservative in terms of your volatility. A lot of people don't know that. Feeling comfortable with your investments and your volatility level is so important that an advisor should avoid encouraging you to take more risk than you're comfortable with. If you ever feel that, you need to leave immediately. But what about an investor who's just too brave for their own good? If you fill out a questionnaire and determine that your personal risk score is an 85, which is about what the S&P 500 is. Remember, the S&P 500 got cut in half in about a year and a half. So if you determine that your personal stated risk score is an 85, but your income levels, your savings levels, your life expectancy is not in line with that type of risk level, then your advisor needs to step in, and be responsible enough to say, not a very good idea. A good advisor should do everything possible to make a strong case for you that you shouldn't be so brave. And that strong case can be made because, again, you can be conservative and still beat the benchmarks. Bravery can be a very dangerous thing in the investment world, especially when you might need the money for medical bills or emergencies. Your investment advisor needs to have information about your health, your income, your debt, all your assets, and more. It should be in one centralized location that you can both review, even if the investment advisor is not actually managing those accounts. So if your advisor doesn't seem to be at least a little invasive in learning about your personal health and financial situation, it might be a red flag. Again, very similar to a doctor. Treat your investment advisor like your doctor and tell all. It will help you in the long run. That is, if you have a good advisor. Otherwise, you're going to end up hopping from advisor to advisor until you find one that tells you what you want to hear. I hope that you do find a good advisor. When you hop on your next call with your advisor, if they can't give you the answers to all of these questions, it may be time to move on. At Avalon, we pride ourselves on knowing these details about our clients' accounts, but we don't stop there. Here's our mentality at Avalon. What we view as right or wrong is how responsible we're being, how well we're delivering the volatility level that our clients are most comfortable with, how well we're communicating with our clients, and honestly, after that, the risk management and the automatic smart allocation are going to take care of the rest. That's because we have a process to get you through any market environment. It's an adaptive investment methodology, and it's what we're built to do. We believe that those who know fare far better than those who don't. It's the very reason that I formed and launched Avalon. So I'm the founder and chief investment officer at Avalon. And we aim to educate, advise, and apply the investment strategies that are used by the smartest, most successful investors on Wall Street. These are people that have made billions and billions of dollars for their clients for decades. We bring the same exact institutional level investing strategies to our private clients. As money and investment strategies continue to evolve, and the environment and the economy and the market continue to evolve, Avalon's at the forefront of the new paradigm of wealth management. The financial advisor industry today, sadly, is largely focused on just acquiring new clients and raising money out of them, rather than retaining existing ones. If they can raise new money and acquire clients faster than they leave, they have a booming business. So a lot of the large firms prioritize a low churn rate model, which means that their success is measured by the number of new clients that they bring in compared to the ones that they lose. There's literally a ratio that they look at. And these are firms that farm out portfolio management, like the actual money management, to third-party companies like mine. And some of these third-party companies, unlike mine, are relying on outdated investment strategies that might not even be effective anymore. Many of these companies are not registered investment advisors, RIAs for short, and they may not have their clients' best interests at heart. Instead, they may be more concerned with serving shareholders or earning commissions. Avalon is different from those. We don't have anybody to answer to. So first, Avalon's an RIA, independent. legally bound to serve its clients' financial interests. So a registered investment advisor in general is the most fiduciarily aligned with their clients. Second, we manage our clients' portfolios in-house. We are investment advisors and money managers. So most investment advisors are not also money managers, but we are. We have the same advisor handling client communication, managing their investments. Third, Avalon charges a flat fee, does not take commissions, does not charge additional fees, and we work with brokers that don't charge you commissions either. Fourth, we're a privately held company that answers to our clients only. You are our boss, not shareholders, not a board of directors. Finally, Avalon's investment strategy that we use, it's unique. It's tailored to each client's risk tolerance, and we prioritize risk management over predictive philosophy. So market timing is the least important thing there is in money management. Risk management is by far the most important thing there is. So this approach has helped Avalon maintain high client retention rate relative to the industry, even during difficult market conditions, or especially during difficult market conditions. We have a unique approach to investing that requires clients to unlearn conventional wisdom. And this is our biggest challenge, I would say. This is our biggest hurdle. So people have learned the wrong way to view financial markets. Our unique approach to investing is something that we teach, we educate our clients with. So we require clients to somehow unlearn their conventional wisdom and adopt a more sophisticated, easy, simpler, contemporary strategy. So our investment approach combines relative strength investing with risk management, also known as dual momentum. And we do this to ensure your portfolio is aligned with your risk tolerance level. So again, we have dual momentum, dual relative strength, and we're aligning it with your personal risk tolerance level. Our process focuses on the relationship between market movements and your comfort level. And we aim to prevent clients from overreacting or making hasty decisions during times of underperformance. And underperformance will happen. It's going to happen. I'm telling you right now, you work with Avalon, we're going to underperform because our goal is to outperform over time. So we use investment methodologies that outperform benchmarks over long periods of time. And mathematically, the only way it's possible to outperform the benchmarks is if you're willing to go through periods of underperformance. So our strategy, just like all strategies, will go through those periods of underperformance, but our framework allows you to detach your emotions from your investments. Some of our most conservative portfolios that have a heavy weighting in fixed income, which doesn't have a high volatility level, actually outperform the S&P 500, a pure stock index. Our framework ensures that your investable assets are matched to an investment model or a series of investment models that are directly aligned with your risk tolerance level and your financial goals. So here's how it works. During our initial conversation with potential clients, what we do is we prioritize understanding their financial goals, and we prioritize understanding their risk tolerance level, their risk number. But by using a combination of our proprietary investment models and your personal risk number, we carefully craft a portfolio for you that is rules-based, sticking to those rules strictly every single month, rebalancing the portfolio. So it doesn't include intuition or opinion or premonition. It doesn't include any emotion whatsoever. This approach ensures that your portfolio is aligned with your risk tolerance level in terms of volatility, while also seeking to outperform the benchmarks. We don't try to predict the future, but instead we use a rules-based algorithm to identify trends in leadership that dictate how we position our model holdings. So let me pause here for a second because this is another big one. If you have an investment advisor who tells you what he or she believes is likely to happen over the next 6 to 12 months, and then they'd say that you're positioned for that, stop and think about what they've just told you. They told you that they're trying to predict the future, and they have taken your life savings and positioned you to benefit if they are correct about their prediction of the future. That's a terrible way to manage money. So if you ever hear somebody say, well, this is one thing's gonna happen in the next 6 to 12 months, and therefore that's how we're positioning you, it's time to leave. Okay, the fact that there's a war going on, or that the Federal Reserve is raising rates, or that the stock market is seriously shifted, or if the White House is proposing $1 trillion bill of some sort, has no bearing on our decision on how we invest your money. It's specifically and only based on price behavior. We don't engage in performance chasing. We don't engage in day trading. I'm not gonna day trade your nest egg or rely on reading tea leaves, because these methods they don't work in the long term. They might have worked for you over the last year. Your advisor might look great right now, but it's important to understand that when you invest with Avalon, you're not investing in any one asset class that we predict is going to do well. You're not investing in tech stocks or industrial stocks or junk bonds or treasury bonds or corporate bonds. You're not investing in industrial metals, precious metals, oil, or agriculture for commodities. Instead, you are investing in a proven rules-based framework, and it's called relative strength. Relative strength is just one of many ways to invest in today's market. There's a lot of different investment methods that do outperform benchmarks. Relative strength is the one that we master. It's very similar to a type of martial arts like karate or kung fu or judo. Relative strength is our kung fu. It's what we do best. Let's talk about relative strength a little bit. So our version of relative strength is more sophisticated and more effective than many other types of investing strategies. So there's lots of different investment methodologies that are rules-based investment methodologies that are proven to outperform the benchmarks. Relative strength happens to be the one that we are masters at. So relative strength investing can be applied to various asset categories like US stocks, international stocks, fixed income, commodities, currencies. It works across all those asset classes. And it's based on the principle that the best performing asset classes tend to have a sustained upward momentum. The leadership tends to continue. So whatever asset class is the strongest tends to continue for months or even years, while the worst performing asset classes tend to continue to struggle. So the core idea behind the strategy is to identify leadership trends in the markets through 6 major asset categories. This is a categorization method that we use. Basically, it's an investing framework that we use to clearly understand what's happening in the market. So those 6 asset categories are international equities, commodities, cash, domestic equities, so US stocks, fixed income, and currencies. So those are the 6 major asset classes. And when you work with Avalon, the way that we report your account to you when you open up your screen uses that categorization method. Now I understand a lot of investors out there don't want to know how the sausage is made, but it is important that you view your account and we're speaking the same language. So we make it very easy for you to understand using these categories. Each one of these 6 categories has different sectors that comprise the category, and their performance might shift over time. So the leadership of the sectors within that asset class or that asset category changes based on variables. And those variables and events across the globe have an impact on what your investment account will hold. So the aim of relative strength investing, the methodology that we use, is to not try to predict how these different factors are going to affect the market, but to just follow the leaders as they perform. Because when you see something start to outperform and suddenly take the #1 spot in terms of price strength, it stays up there for a very long time, months or even years. And we do this by investing in long-term trends. The long-term trends happen because of major things. That's why the long-term trends are most reliable and most consistent. And besides, we're managing your life savings, so we're investing in big, stable trends. And these long-term trends occur because of seismic shifts in the global economy. It might be what wars are being fought, who's in charge politically, droughts, things like that. So the strategy views the market through a longer time frame, and that's the safest timeline for your time horizon in terms of your nest egg that you've been saving your whole life. This is where prices move with purpose. Okay, these long-term trends, they're not random, they're not chaotic. The shorter the time frame is, the more random the trend will be. So we take a long-term approach to your investing. In closing, I'm going to leave you with a quote by Peter Lynch, the famous fund manager. Long story short, was incredibly successful. Spend at least as much time researching a stock as you would choosing a refrigerator. What he's saying is how to invest your life savings, how to grow your wealth is one of the most important decisions that you can make. Therefore, it deserves some extra consideration and research. Be willing to not just spend some time, but call it invest some time upfront with your investment advisor. Otherwise, you're going to be spending a lot more time down the road patching things up. All right, and the same should apply to the advisor you're selecting to manage your life savings. That person should be very interested in spending a lot of time with you up front. And we strive to educate the public on our approach and how it's vastly different from what they're used to out there. But we also ask that you take some time doing your own research. At least take some time to get to know how the investment advisor manages your money. You didn't accumulate your wealth by making poorly informed decisions, right? And either you or somebody out there worked damn hard to accumulate that wealth. So why not invest some of your time into understanding how to intelligently invest your money and finding out who the best advisor is to do that. Again, this is a time investment. You get to choose whether you spend a little bit of time or a lot of time later. The world's changing, money's evolving, investing methodologies are becoming more sophisticated. It's been my life mission to make relative strength investing something that everybody knows about and understands, as well as your risk score. So keep your eyes on your inbox for your next issue of Adapt, our free e-letter, and let the learning begin. Until then, take care, and thanks for tuning in.